Hello and welcome to the Gold, Goats, and Guns podcast for February 24th, 2023. My name is Tom Luongo, and we have a lot to talk about. It is episode 135, and I have with me the great pleasure of finally getting a chance to have a one-to-one conversation with Vince Lanci. You may know him as VBL, and you'll see his work over on like Zerohedge, and he and I chat on Twitter all the time. So we're going to talk about, well, a lot of things that have come up since Vince and I first shared a Twitter Spaces with the hosted by Palisades Gold Radio about, I don't know, 3 or 4 months ago now. And it has just blossomed into a really cool back and forth conversation. And I wanted to get Vince on the show today to do that. So Vince, good morning. How you doing? What's going on, my amigo? What's the gig?
Well, thanks for having me. That's spot on. That's basically how it's evolved from there. First of all, thanks for the opportunity.
Sure.
It's always nice to be able to reach a broader audience of similar-minded people and to have an intelligent conversation with someone who there's an overlap with, but there's also some things that I can pull out of you and learn as well. So I'm happy to be here.
Cool. All right. So one of the things that was really interesting is like this week, I remember when I think when you and I first talked, or we were first, we're on that Twitter spaces together, and I mentioned the idea of how to recapitalize the United States, and what I mentioned was Judy Selton's idea, which wasn't really so what I'm looking for, publicized by the Trump administration when Mnuchin, Treasury Secretary, was talking about 50 and 100-year bonds. But apparently, Judy Shelton was involved in that conversation. They were talking about 50 and 100-year bonds with some kind of gold cover or gold redemption clause. And I said, and I mentioned that, and you just went, whoa, and it just lit you up. And then that's where, that's where this started with us. So gold is the focus of this conversation today, but not from the typical, y'all must buy gold because the end of the world.
The focus is money and the world that we live in. You know what I mean?
This is a much different different level conversation, and probably very hopefully technically interesting. So with what you were talking about earlier in the week on Twitter about China setting the stage for effectively the digitization of gold for settlement purposes is what really got me like, no, I have to have Vince on the show now. Now we need to talk about this, because that was an evolution of a lot of ideas that have been percolating in the back of my head for a long time. So take us through what you're thinking and what you're seeing from the Chinese and obviously from the Russians and the Iranians and all of that, and pop into there. And let's start there and we'll see where we go.
Okay. The moment that you're referring to is where I kind of organically said, oh, shit, this is how you get your people on digital currency. Now, there's an overlap here, and maybe it'll sound a little tortured, but I don't want to equivocate too much. It started with, I want to go back to when we first talked, if you don't mind, okay? Because they'll see the path that I'm on and how we basically just intersected. So we're on this Spaces, this Palisade Spaces, and I had a definite opinion that the Fed was going to pivot at the time, and that was part of the conversation. And we know it was bullish for gold, constructive for gold, et cetera, et cetera. And you interjected in a moment that they were ready for that. You were talking about they're not just going to. You implicitly just said they're not just going to hit a switch. You're going to remonetize gold over time. And as you said, it kind of exploded in my head, because in my head are all these pieces that weren't connected. And I'll give you examples of like 3 of the pieces so you can see why I would just go, oh shit, that's the answer. When I started in finance, I was at Lehman Brothers, and I was like a copy boy at a managing director's desk. And but on my left on my right was a CFA. I was like their copy boy. And on my left was the head bond trader. And so I was basically getting them coffee and unrolling faxes. And the bond guy was always trading while he was working with the MD. And I would hear him talk about gold a lot. And I wasn't particularly fascinated with gold, except that I remember it was something that kind of saved my family in the late 70s. And, I was the eager student, and I was constantly hating me. They loved me, but they hated me. I was constantly asking the CFA about fundamental analysis, and I was constantly asking the other guy about bonds. And one day I said to him, I said, I had their ear. I said, why are you talking about gold if you're doing bonds? He goes, well, we trade gold on the bond desk. And I said, well, isn't gold a commodity? You know, I didn't know it as money. I wasn't raised with it as money. It was jewelry and it was something to keep value. And he goes, no, gold is money. And I said, what do you mean? Well, and then he went through the whole gold is money, 1971. I was too young to even know what that shit meant. And then he said, as a result, gold had historically been on the bond desk because, and this is the core understanding of where money comes from. Money can only be paid in money. So either money's worth X now or it's worth X plus more of itself in the future to be delayed. So the time value of money, et cetera, et cetera. But he goes, bonds were tied to gold. And so when they divorced gold from bonds on the desks in the futures in the US market, that's not how the world went. The Swiss still had their gold. Gold was the alternative to whatever the risk was. It was truly the risk. So they always looked at gold when they traded bonds. So that's the first piece. I'm like, gold, bonds. Right, gold is money. And then I pursued that over the years, learning about gold versus money and how term structures and interest rate curves would work and all that stuff. Okay, so the next thing is, which brings us to more of the current events. I had read something by a governor in the Bank of China, someone at the People's Republic of China, and someone said to him, I can't find it on the internet anymore, but I found it years ago. Someone said to him, China doesn't really have enough gold to compete with the U.S., right? And all paranoia aside, they probably have it hidden in Manchuria, all off balance sheet shit. But all paranoia aside, the guy just looked at him and said, he goes, you misunderstand gold. I mean, China owns gold through its people. And so now I've got, okay. And then I said, okay, well, that means, and I wasn't looking at it as bullish for gold. I was like, okay, that's a confiscation comment, right? They can always claim it. And I thought about the US history. So now I've got these things in my head. I got China and gold. China has more gold off balance sheet that they can get. And then this bond thing, which has been buried in my subconscious for years, right? So and I became a student of a market structure. I'm like, okay, gold's not money because you can't exchange it. It's a 50%. It's sold before Basel III, 50% haircut. You can't really use it for anything. They made sure it wasn't money by demoting it tax-wise. And then you make this comment that, and I can't believe I didn't know that she had said this, but they're going.
To be fair, Vince, she only said it recently on a podcast that she did with Grant Williams, and I only heard about it through my people who are subscribers of Grant's, and they're like, Tom, you have to listen to this. And so I got a copy of the podcast, and I listened to that, and I'm like, oh, and I didn't quite understand it either. I said, okay, well, that makes sense, because I always remember Jim Sinclair saying eventually this is going to end with a 5% gold cover clause, probably tied to global M3 or something along those lines. That's what he was talking about back in like 2005, 2006.
Right.
Okay.
Right.
But just to be clear, when she mentioned this about the 50, 100-year bonds with a 5% gold redemption clause, it was a lightning bolt to me as well.
Right. Okay. All right. So now you're bringing me to the next point. When you want, and this comes from an analyst who really knows the industry. This is another piece of the puzzle that just plugged it all in when you said long-term bond reintroduction. Because the thing that I couldn't wrap my head around is, let's pretend that I want a gold standard. I'm not saying that I want it, but let's pretend that I do. You can't get a gold standard. You can't hit a switch overnight and do that, because you create chaos. You destroy what you have. You need to protect the current regime while introducing a new regime. And the surefire way to do that, speaking academically, is you make the old compete with the new. And so in the Western capitalistic way, as opposed to a state just saying it's mandated, you say, okay, you can drive a gas car, but you have to pay a tax. And we're going to take that money and we're going to subsidize the EV. You make the new subsidized by the old. And my personal experience with this, and before jumping right to the gold thing, is when I was on the trading floor on the NYMEX, they wanted to start a pilot program for electronic trading. And so I went to my analyst friend. I go, how does this work? He goes, well, what they're doing, and he had an Argentinian accent, He's like, Vince, what they're doing, and he just fucking laid it out. He goes, they're not going to, and you think about this, the population of the floor is the population of China. All right? Okay. So, or anyone else that you want to change their vibe, change their attitude, dollars to gold. All right. So the floor was all about, I'm on the floor, I scream, I jump up and down, and I trade. Now, it's easy to be diminutive about those people, but they were the liquidity pool. They were business. Without them, there's no bid ask. Without them, there's no product, there's no market. Truly essential to capitalism. So, but the CME, which had bought the NYMEX, said we need to get this liquidity pool electronic so we can broadcast wider, make more money, extend our reach. Fine. Okay. They're a publicly traded company now. How do you do that? You don't shut the floor down, which would be like saying we're not doing dollars anymore, we're doing gold, right? Just shut it down. You don't make an announcement that you're going to fade it out, because that just starts people panicking for the exits, right?
Of course.
Okay. So what you do is to paraphrase the analyst, you make the existing infrastructure compete with the new infrastructure economically. You incentivize the existing talent, right, to go with the new aspect. So they approached me at the time and they said, okay, here's what we want you to do. We're going to give you a tablet and you're going to plug in and we're going to pay for all this other stuff. And you're going to trade the floor like you normally do, but we're going to let you also broadcast your markets electronically. So the floor was like a fiefdom. We're not sharing. I was like, screw that. I know where this is going. So little by little, you got people, I was like an early adopter. So you have people, but there's tablets all over the floor. And eventually the prices on the floor are better. The prices on the screen are worse. And eventually, anyway, and to facilitate it, then you approach the customers, the big players, right? You approach the banks and say, commissions are 50 cents on the floor, 20 cents on the screen.
Right.
And you, over time, you just you ring fence. That's the key word, right? Ring fence your liquidity pool, and you eventually move them over to the electronic screen. And at the same time, you don't disrupt what's externally facing the world. So I went, okay, I knew that model existed. That's the network model and how to protect your network. I knew that model existed. Then I had this gold thing on the bond thing. And then you said that, I went, oh shit, we're not going to hit a switch.
Nope.
We have to get more sound money. Now, we can do that many ways. We can stop printing dollars. We can pull dollars back. Well, we're going to do that. We're just not going to announce it like we're doing it so drastically. How do we get back to a more sound money? Well, you can't hit a switch, as we said. And I said, well, how do you phase gold in? And you said it. You phase gold in by phasing it in over time, right? Right. And you let the free, it's actually a brilliant capitalistic approach. You let the free market determine the price over time. Yep. You throttle the interest by not making it be a rush for the gates. And then you slowly say, okay. And then after all that, and after seeing that, I said, all right, well, how do you do that? Right. Well, the rule's already on the book. They're not going to change the rule. When Nixon said the gold window's closed, they weren't going around confiscating gold and silver dollars. No, they were just saying when they come in, we retire them. Well, that's what they're going to do the other way.
Exactly.
I mean, so
that's just one aspect of this, Vince. I've got another one, Pop. I got another thing I don't even quite fully understand that I was chatting with some people about some of my patrons about. And there's a whole nother thing going on with the Fannie and Freddie preferred stock thing that I don't even fully understand, but they're trading at unbelievable bid-ask spreads and they're completely illiquid because someone's accumulating the shit out of them.
You talking about Fannie and Freddie?
Fannie and Freddie preferred stock issues. Okay. There's like 13 or 14 series of these things. And, at some point, like that is also another mechanism by which to potentially recapitalize, these markets, this country as well. And because you're tying it again you're tying now the currency and, you're starting to tie the currency back to hard assets. So, there's clearly something happening in that that realm as well. And I've been sitting on this for a few months because I still don't quite understand it, because I LARP as a bond guy. Let's not kid ourselves. I've never traded a bond in my life. I've never done any of that stuff. I'm learning every day about the stuff in order to try and get better and up my game. Right.
But
so
ultimately, you and I both know it's present value money versus future value money.
Right. It's really what it comes down to. It's always about present versus future value. Right. So when you think about this, the idea of throwing, as you put it so eloquently, throwing gold out on the yield curve, by the way, a phrase I had never heard before, and now I use it all the time. FYI.
Thank you.
No, I absolutely use it everywhere now. I'm like, oh my God, that's so good. It's so great.
And by the way, I'm sorry to interrupt, but isn't this what government does in general? Everything gets kicked down the road.
Well, of course.
Do it immediately. Anyway, I'm sorry. Go ahead.
Yeah, no worries. Like, but if you think about it, right, it is the way to get back to a reasonable. To start, you have to rebuild the confidence in the institutional systems. And the way you do that is you say, look, we know we can't afford to refinance the debt at whatever the terminal rate on the Fed funds rate is going to be. And I think it's going to be 7%. Everybody's like told me a year ago that I'm nuts for even thinking anything above 2. And I'm like, no, 6. And and I was just like being a bitch, actually, to be honest with you. I was saying 6 to get people angry.
Oh, no, I disagree with you when you said it. And then I shut up and I thought about it. I went, if Powell's serious, it's going to 6%. They're basically looking at the Taylor rule again. Fuck, he might be right. I'll shut up.
Fair enough.
That's what happened.
But so you start thinking about what the term structure of those bonds would look like. They would pay a nominal dollar coupon of a couple of percent, right? And then allow the investor to get the spread and the yield, the rest of the yield, in their appreciation of gold every year. And now that monetizes and incentivizes the Fed to allow the gold on their balance sheet to be revalued upwards with a rising gold price. And then they don't even have to ever pay the bonds back in gold. They can just retire the thing 15 years into the 50-year bond, like Greenspan did with the 13% 30-year debt that Volcker issued.
Right. That's right. And just to add as a footnote, if someone has a hard time saying, well, they have to pay the gold. No, the key in all Western financial markets is they want to take everything that's real and financialize it. So they do not want you to have the gold. I'm not saying that you're not going to have the gold, but I'm saying that they want to financialize as much as they can. And so that may mean 15 years down the road, it's like, we'll settle in cash. The new dollar.
Well, they don't even. It's not even that. They will incentivize you by paying you out at par in dollars. Right. If so, let's just run it out for people who don't understand the numbers. Today, gold's trading about $1,800 or $1,825 an ounce or whatever it is. So you buy a $10,000 bond, $500 of which is redeemable in Treasury gold in the future. X amount of gold in today's money, and then it rises to $5,000 an ounce. So now they're going to pay you on that $500 in gold that they would have paid you originally. They pay you out of par at $1,500 or $1,800, whatever it is. To say gold goes up three times. Well, they're going to pay you that portion of the yield.
They're going to
pay it to you in dollars, but they're going to incentivize you to pay you at par in dollars. They're going to pay you what the full value of the bond is. They're going to pay you then, and they're not going to wait for it to go to $15,000 an ounce. Like, that's what's going to happen. No different than when Greenspan, again, like I said, retired the 13% debt after interest rates had come down to 6-7% on the long end of the yield curve, but he bought it all back at par and retired it all. And it cost us some money, but we were in a position then to pay that out, and they did.
That's exactly it. I mean, and that's like that. Some people will get hung up on the mechanism of how they do it, and I'm flexible with that as you. It's what they want to do. It's the intent. And the intent is, and I say this in a positive way, is to preserve the nation, to preserve things. And to do that, you have to, boil frogs slowly if you're not.
Yes. No. And now the question that I've been constantly looking at is going, okay, well, I think of this as a big chess game now between the Treasury and the Fed, because the Treasury clearly works for other people.
Right.
The Treasury under Yellen and Bernanke and Geithner and all the rest of them have clearly always worked in order to pump up the offshore dollar markets by keeping money cheap so that they can have all the credit in the world to do whatever shenanigans they want. And basically, the shadow banking system is the source of new credit and new dollars around the world, not the Federal Reserve, not the U.S. commercial banking system.
Right. Right.
This is the key this is the key to the way I look at this stuff. So now let's tie it into what you think is going on with China, because that was my original. My original tie. I don't want to get lost in that. I want to get back to your original tie.
Okay, yeah.
I talked about this shit until the cows come home.
Okay, so first of all, I think, and this is kind of derivative of stuff that I've heard you talk about as well. The U.S., because of your comment about the Fed being possibly the last bastion of resistance to the MMT philosophy, meaning they're inflation hawks, right? More so than the rest of the administration, more so than the Treasury. Let's put it that way. So when philosophically, when you look at it that way, the U.S., because of the Fed and probably other people, will be, I believe, one of the last, if not the last country to go with a central bank digital currency for reasons you made clear. It's not in their interest. It obviates banking, right? It obviates commercial banking, right? So for whatever reasons, but those are legitimate reasons. And the other reason, and the reason that I throw into it is, well, we're the incumbent power, so we can afford to wait and see how people screw it up or do well. Which brings me to China.
Right.
China is pushing the digital yuan. Now, I don't know how hard they're pushing it, but it's been a failure so far. It has been I wouldn't call it abject, but they haven't convinced some people. And there's cultural reasons for that. There's culture. I worked with a professor who would spend some time in China, and he filled me in on the cultural aspect of China. And it's not so much Chinese, it's more a function of bureaucratic communist administrative philosophy. And what he said was, he's like, well, the Chinese have had many, very naive on this stuff. The Chinese have had frequent revolutions. And so because of that, they're reticent to trust government, as many countries are. And because of that, they like to keep their wealth portable. They don't live in fancy houses. They have jewelry. That's kind of, that's it. They'll wear their wealth because they want it to be portable. Okay, so that's the culture or the philosophy of the citizen who's trying to protect themselves from whatever's going to happen down the road with the next, lunacy in government, right? The government, meanwhile, is all about centralization, right? So they want to port their liquidity pool, right, their trading floor, onto the digital yuan, which would accelerate them getting off the dollar. Now, they can't culturally get their people to do that because they don't trust government.
Right.
They're libertarians squared, cubed, right. whatever. Maybe they don't have guns, but they probably have a lot of, slingshots and gold bars to throw at them. Anyway, so if you run into that, and then you're also talking about a state authoritarian government where they don't really have they're strategically smart. This is my opinion. Strategically smart, tactically stupid. They will play the authoritarian role, do it because we told you to, as opposed to finessing it. And finessing is probably like, getting punched in the face. So when they say use the yuan or we're going to lock you down, people are like, okay, fine, lock us down. We don't care about it. But I think if they get a little bit smarter, they're going to, and this is where the whole gold thing comes into. I've got this banker in my head saying China owns gold through its people. Well, China is a huge buyer of gold at the retail end, which is another reason why the West is in trouble, because exchanges will move to the East. And that's what
that's it. Yeah, that's also part of this. Because this, just so everybody remind everybody, the Shanghai Gold Exchange is a physically settled market explicitly, as the guys like the guys over Bullion Star have been talking about for years, and charting all of that stuff for years. And it's very important to understand that money, that money, gold, has been flowing into the hands of Chinese people for over a decade now. Okay. And then there's also the tie between the Shanghai Oil Futures Exchange and the offshore yuan based gold market in order to allow the improvement of liquidity of oil futures trading and the settlement risk of not having to take the onshore yuan. You can actually settle in offshore gold in Hong Kong, and therefore oil traders are, that's why the liquidity on the Shanghai oil exchange, futures exchange, is rising as well, FYI.
Right,
so,
right.
Because I'm leading you to the because I can see exactly where this is going.
Oh yeah. But now you've got me. If you'll let me,
sure.
Take a step sideways from that.
Absolutely.
All right, back to my Argentinian analyst. This is something he said that is extremely true, and it's how you can determine what the reserve currency is in the world. Commodity exchanges. This is 15 years before Zoltan. Okay, commodity exchanges do best in the nation of demand, the region of demand. And I said, why? Because at the time, NYMEX was opening a sour crude contract.
Right.
And I said, why? Why doesn't the sour crude contract do well in Saudi Arabia is what I asked him. He said, because exchanges do best in a nation of demand. Why? I said. He goes, well, because demand sets the price on commodities, not supply. Now, hear me out at the margin, right?
I agree.
So we pull commodities out of the ground. If nobody wants them, we stop pulling them out of the ground. You have all kinds of short squeezes, but the simple fact is this. It's who wants the commodity that determines the price. So oil forever has been pulled out of Saudi Arabia, but the volume is traded in the U.S. Why? Yep. Because we use it. Because we're the industrial power, okay? So why does the demand determine it? Because the demand eventually says, dude, I'm not flying over there to pick up my oil. You're bringing it here. So what happens is if the demand is in the United States, the delivery points are in the United States.
Yep.
That means the refiners are in the United States. And everything comes to the United States. The demand, the salesman, the business, the infrastructure, the storage, and basically just pulled out of the ground. So you have the whole colonization concept, right? Pulled out of the ground, monetized over here, and becomes, okay, so now, and this is oil and gold simultaneously with the Shanghai Exchange. So in about between 2010 and 2014, they created their products. And their products nobody cared about because the demand was here. But as the Chinese economy grows, the demand for oil grows. As the demand for oil grows, wealth grows. They have a burgeoning middle class now. Those people are putting some money in gold. And then I tracked it. Just as to right to your point, then I tracked it. We're talking about between the years 2010 and 2020. JP Morgan opens up a trading desk in Shanghai because that's where the money is, right? JP Morgan opens up a vault in Shanghai. The storage is, it's like, and so now the JP Morgan's trader is now trading 3 time zones. And so the demand for gold is there. And so that's why the COMEX vault ends up getting depleted. And for Shanghai, which by the way, is actually being depleted as well. But so the key, if you're looking for a sign that the dollar is dead in terms of its total preeminence as opposed to partial preeminence, the sign is really simply as the volumes on a commodity exchange in China grow and the volumes on the commodity exchange in the US lessen, the dollar's weakness lessens. Because we're no longer, wait a minute. We're buying gold and oil and having it delivered here, and the storage is here, and the vaults are here. And why are we pricing in dollars? Let's price it in yuan because that's what I have. And there you have it. It's over, and then they can just put it anyway.
And dude, no, you're exactly right. And now I want to throw something else at you.
Yeah.
Think about what Davos and company are doing to the oil markets here in the West. They are destroying them. I do a very simple thing. I was telling Lynette Zhang this the other day. I said, I do a very simple thing. I just, when I look at my trading statistics, because I do a very simple quantitative trading analysis for technically, that's the way I look at things. It's just very simply, I want to know what I chart oil and gold and all these things. I just divide the range of the time period by the price, and I get a percentage. Oil moves the range from low to high on a weekly basis in oil is 6.4%. In gold, it's 2%. In silver, it's 4%. Oil is 50% more volatile on a week-to-week basis than silver is. Now, should oil be that fucking volatile? It's the most important fucking commodity in the world. It should be traded. It should be as uninteresting to trade as literal, like, I don't know, cotton balls or fucking paper clips, for Christ's sake. But it's not. And it's not on purpose. Those fucking financial assholes at Davos continue, these fucking Eurotrash commie sons of bitches, continue to attack the price of oil on the futures market, making it the plaything of speculators and not coordinating price and time with producers and consumers.
That's right.
They're destroying the Brent crude contract on ice. And by doing that, what are they doing? They're doing exactly what you just said. They're making the Shanghai contract that much more attractive.
That I didn't think of it that way as that part of their intent, but
no, I think it's an unintended consequence. They just want to destroy the oil trade.
Right. They're happy that it's happening. It's actually a symptom of what they're doing.
Exactly.
Right. The reliability of price here it's like oil is now a meme stock, on WTI. The volatility is too high. And you know what happens? Long-term chronic volatility in any asset takes buyers and users at the margin away.
Yep.
The contract's broken. I'm not going to trade palladium on the COMEX. Why? Because it's like three guys trading it, and it's like a club, and that's what's happening. That's what's happening in oil. Slowly, as liquidity decreases, volatility increases, and what ends up happening is, that's basically it. But that's what's happening. That's a manifestation of what we're talking about.
Absolutely.
And we, I think we both agree philosophically that Davos, WEF, that mindset, they want geopolitically. Well, Davos wants to for whatever their reason is. But geopolitically, if we're at war with Russia and we're at war with China, we are economically, then and they're countries that make money off of, say, the bottom of the Exeter pyramid, more the natural resource.
The bottom of the Exeter pyramid, yes.
Right, exactly. And we make money off of the flat or the top of it. Then that's the innovation. The bottom is the root. We want to make them wrong. It's kind of like the assembly line has been invented, and the assembly line is whatever replaces oil, and we want to get oil as low as possible, and we'll tax our people, and in doing so, hopefully break you economically, kind of like the USSR thing.
Mm-hmm.
What's going to end up happening is whether we succeed or fail in that endeavor, as a nation, as a trading bloc, we will destroy the contract. And by destroying the contract, you're helping the Shanghai contract. And by helping the Shanghai contract, you are weakening the dollar.
Yes.
That's it. That's simple.
Yeah. And this is why I've been banging my shoe on the table like fucking Khrushchev, saying this is why the Fed won't pivot, because de-dollarization is happening, and they're fighting not only a hostile freaking Treasury Department and Obama administration that's literally trying to sell the country out to a bunch of Euro fag commies, but at the same time, the East is going, you know what? Fuck you. We'll just turn around and we'll price our oil in a gold derivative, and and that's that, and then the dollar weakens, and so the Fed has to slop up all of these freaking offshore dollars. They got to retire all this offshore dollar debt, or they got to at least get rid of the leverage of it and crash all of this stuff. And this is why I'm like, it makes perfect sense to me that if I were Emperor Palpatine and I wanted to save the dollar, I'd be like looking at Christine Lagarde's neck scarf and going, that's it. I'm taking you out, honey, because you are the IMF and Austin Carstens over at the BIS and all these freaking assholes, because none of them actually have any real power, because they don't control. They thought they controlled the dollar, but they don't. Right. They controlled it through a willing Fed and a willing Congress. And when I've been arguing about the Eurodollar markets, Jeff Snyder's done great work to identify the Eurodollar futures curve as a predictor of future Fed policy.
Yeah,
only if the Fed was willing to go along with that.
Right.
Sorry, I never bought this argument that the Eurodollar markets are a free market evolution against the central planning of the Federal Reserve. Like that, the minute I heard that, I'm like, oh, you've got to be kidding me. The Eurodollar system was always a way to iterate Europe's banking power. another iteration of Europe's banking power going back to the friggin' Venetian banks of the 15th century and the Bank of England, formation of the Bank of England and everything else. It's all just a continuum. Do you make money? You keep divorcing money slowly. Every iteration divorces money further and further and further from the work that goes into the opportunity cost of producing the commodities in the first place.
The Webster's in the ionosphere abstracting away.
Yes. And
And
Putin's down there in the trenches going, oh, by the way, I want gold.
Right, exactly. There's like, everyone talks about, well, I'm interested in, you hear people giving lip service, signaling the real matters, the people matters. Well, the real will matter a lot more when you are the person freezing, when you are the person who can't eat. And then we'll see how abstract you are about money then when you or you're using a wheelbarrow. Absolutely, absolutely. So I have questions about the Eurodollar, but before I ask them, I wanted to finish up the whole Chinese thing.
Sure.
So if I'm China, right, and I'm getting a little bit of tactical awareness, and culturally I have a problem. I can't get my people to use the yuan. I'm not really good at selling. They're not really good. They're not really good at that. They're really good with the truncheon, but that's not necessarily the marketing. And I want, and this ties in with the Russia-China BRICS concept anyway, you need to create secular liquidity for gold or a gold-backed currency. Let's say it's the yuan, right? You need to do that in order to facilitate. You need to project your power to the rest of the world and say, see, and in order to do that, you need to have organic, continuous liquidity. It's a diverse liquidity pool. It's not just you saying 6 bid at 7. It's a billion Chinese saying I'm 5.5 bid at 8. And there's the market. So what's a way to do that? To centralize your people, to get them on a digital yuan, and at the same time undermine the dollar even more. And that's to say, now I'm just making this up, but the concept is valid. And that's to say, you treat your digital money like coupons, which is what's going to happen in the West anyway. Digital money, it's like, Amazon, it's $5, but if you use Amazon bucks, it's $4.75. Right. That's digital money. That's how that works. It's an coupon. So in China, they can be a little bit pushier. They could say, all right, here's what we're going to do. You like gold? We like gold. We put out a paper last week demonizing the dollar more. Here's what we're going to do. Anybody who uses the yuan can get paid, can get 20% more. And we'll put that 20% in gold. Well, they're not going to get their gold, which, by the way, this is an offshoot of the concept that we talked about with the gold bonds in the U.S.
Exactly.
Right. So, and Billion Star is big on this. The Shanghai Exchange vaults, the gold doesn't leave China. It just doesn't. It goes in, and it stays there. If I'm Russia and I'm getting paid in gold, and I'm pretty sure this is true, the gold stays in China and they give me a receipt. So blockchain and M-Trade and all these technologies, they're trying to create a platform that allows for quick fungibility of gold. Whether blockchain is needed or not is irrelevant, but it certainly makes people more amenable to the idea. But then you go to your people and you say, you want gold? We now have it on blockchain. It's verified. You can buy gold using the yuan. And now you have a billion people. I mean, I'm exaggerating, but I'm probably not. A billion people say, yeah, I'll buy a gram of gold. And when they do that, as a country, you also have cover. We're not manipulating the currency market. That's what the people want. And doesn't that make sense for a communist country to do it that way?
Well, yeah, there's a couple even bigger issues about that. You're right, and I'm just freaking. I'm not going to
throw it out.
Keep going, which is to say this: the biggest barrier to eroding the global reserve currency is nobody wanting to hold each other's crappy fiat currencies. No one wants to hold the Indian rupee. No one wants to hold the Russian ruble. No one wants to really hold the yuan. But if you tie them all underneath and convert, and basically you have back-end settlements at the end of all the national trade, and this is where it's really more important to me. It's the national trade level stuff, right? It's the stuff that goes through the Exim banks and the central bank current accounts of the countries, that at the end of the day, if they can just do a quick settlement of everybody's trade and go, okay, well, you're credited with this amount of gold here and you're credited with this amount of gold there, and it's all verified on their replacement for Swift. Their blockchain replaced their version of Swift, which is Mbridge, if I correct.
So it's going to be whatever it is, but right now,
whatever it is. So let's just pick whatever it is. It doesn't matter.
Right.
And oh, by the way, Martin Armstrong this morning came out with something saying, oh, by the way, in the last year, the Chinese Swift replacement CIPS has doubled in volume over the last year.
Yeah, that's a big deal. That's the success of a contract.
Yes. So all of those things are there. So now these countries don't have to hold the other currencies as and have they're open to that currency risk. They're all like, yeah, we like gold. The Russians like gold. The Indians like gold. The Chinese like gold.
Right.
Guess what?
Right.
We're good. The Saudis like gold, which is why they're going to sign up for this system. Like it's
why they're building refineries and
why the Iranians and the Russians are merging their banking systems and all this stuff. It's all happening. It's all happening right here. And you put out a really cool little thing the other day and I retweeted it because it was fantastic, which was that, about a minute and a half, you were chatting on Twitter and you just put up this little audio thing about the Wile E. Coyote economy. And I was just like, it's hilarious. So take people through that real quick and then we'll move on to the next point. Or we'll
okay. So the Wile E. Coyote thing is really a comment on if you watch the Wile E. Coyote Roadrunner cartoons, I read about how they developed them and the creators, the Warner Brothers said, we're not, whatever we do, we cannot let the Roadrunner cause the coyote harm overtly. So the Roadrunner is passive aggressive. But the point is the coyote does everything to himself. He shoots himself in the foot. He causes his own demise. Mm-hmm. And that's why you can have pity on him and at the same time not hate the Roadrunner. And so the United States is the coyote right now, constantly doing things tactically to compensate for this long-term strategy of China, the Roadrunner. And all we keep doing is blowing ourselves up. So a simple version is sanctions. Sanctions work until you make it to the point where the person you're sanctioning says, well, shit, this is like 75% bad, 25% good. Why even bother? And they just jettison it and do something else.
Right.
So that's the Wile E. Like we're the Wile E. Coyote right now. And maybe we'll win in the long run, but we'll also shoot off all of our appendages, and those appendages are the standard of living of the United States citizen.
I think, and this goes back to, I don't think that the Fed or the New York boys like JP Morgan, I certainly don't think that that's what their goal is. I think that they've woken up to this. They've realized it very careful. They've realized very seriously what's going on here, probably better than either of us have.
Right.
See, this is the thing. Like, look, at the end of the day, it's our plutocrats versus their plutocrats, right? And our plutocrats are not going to go willingly gently into that good night and be destroyed. Right. When I sit down and I think about Jamie Dimon and I look at Klaus Schwab, or I look at Christine Lagarde, or I look at Carsters, or I don't know, pick any of these feckless European assholes, and I go that guy's going to genuflect to Ursula von der Leyen. Yeah, really? Yeah. You think that's what's going to happen? I'm making the power hands here, like he did the freaking Ilhan Omar during the ESG meeting. I'm like, yeah, no, it's not happening. So when you think about it that way, and then when you really go back over the last 5-6 years, like the minute the big reason that they all lost their fucking mind that Trump won is because Trump put Mnuchin in the Treasury, was going to put Judy Shelton on the freaking Federal Reserve Board, and got John Williams into the New York Fed, who was the architect of SOFR, and which then made sure that we have the end of LIBOR, because LIBOR is the means by which the Eurodollar markets have always effectively controlled Fed policy, especially if you have a bunch of, at best, useful idiots in the form of Yellen and Bernanke, as the way Daniel DiMartino Booth explained it to me the other day, and at worst, malign actors in the form of Bernanke and Yellen. Danielle happens to think that they're just, kind of shockingly naive, useful idiot intellectuals. And I happen to think that Janet Yellen is not that at all. But that's, we're allowed to, we're clearly allowed to disagree on this, but the net effect is the same.
I think, yeah, exactly. The effect is the same. It's kind of like malicious or ignorant. That's kind of like it, naive or ill-intended. And I think when you look at I think on individual cases, I don't know who's what, but probably individually, 8 of them are useless idiot minions. They believe it because they get paid. It's like, it's your religion, right? And then a couple of them understand and see things for how they really are and choose to go that way. I don't know who's who.
I think Yellen has morphed completely into that person, because every move that she makes she's made since she's been Treasury Secretary has been a complete 100% accurate strategic move against anything Powell has done.
Right.
When I look at it, again, as the chess game, I look at Yellen's moves to do what she's every moment that she gets an opportunity. What she sanctions, the whole pressing, the whole Treasury QE thing, which Operation Twist thing, which is clearly designed to spoof the bond markets into thinking that the Fed has made a policy mistake by pressing on the 210 spread. Selling 2 years, buying 10 years. I'm like, really? We can't fucking see you stupid cunt. Like, seriously, I'm that angry with Janet Yellen at this point. Because it's very clear that that's what she's doing.
I haven't seen that link, but I saw it. I probably started seeing it a couple months after we had that conversation when I went, oh, the Fed and the Treasury aren't on the same page anymore. Right. But I was slow to pick this up. It's like, oh, yeah. And then I looked back and I said, wait, didn't Yellen want the Fed to be folded into the Treasury at one point?
Yes.
Right, exactly. Then I went, now.
And then the Biden administration was floating ideas about taking the restructuring the Federal Reserve from 12 banks down to 5.
Right. Oh, I didn't know that. See.
Oh yeah, no, that hit about a month ago, and then quick, and then the new Republican Congress quickly went, no,
right, exactly.
Fuck you. That's not happening.
So basically, every time Yellen went to Powell, we need you to lower rates, and he said, no, I care about inflation more right now. Yellen did something to do an end around on it.
But I'm telling you that Powell has been saying this inflation story is nothing but a cover. His real goal is the collapsing of the offshore leveraged loan markets, which is a collapse of the offshore Eurodollar markets. Like, this is the point. And when I talked to Danielle about this again about 2 weeks or a week and a half ago, she went, yeah, this is kind of what's going on. That's what QT is all about. You shrink the balance sheet.
Okay, that's over my pay grade. Can you?
Okay, so think of it this way: like when Powell first goosed the reverse repo off outstanding balance, right? Go back to June 16th, 2021.
Okay.
Right. Biden is in Geneva, delaying World War III, talking with Putin. On the same day, the Federal Reserve doesn't do anything but raises the reverse repo payout rate 5 basis points over the Fed funds rate. I've gone over this many times. The reverse repo balance goes from about $478 billion. By Jackson Hole, it's at $1.7 trillion, and then it hits a high of $2.5 trillion. That is literally him. One, he's trying to stop the flood of money coming in and sterilizing the money that the Treasury was going to spend because of the CARES Act. There was like $1 trillion worth of spending that was coming, which goosed GDP and created all this inflation. But part of it, when I did like the mass balance on this, the money balance, the mass balance on this, and there was about $700 billion in base money removed from the global liquidity pool. I mean, over and above what the Treasury spent, over $700 billion over the next 6 to 8 months was removed. Right. Well, guess what? That's M0 of the Eurodollar markets.
Quick question. We did that I'm being very simple and pedantic so I can get this. We did that by paying the banks a little bit more to not.
Yes. And because the banks couldn't go into the market at the zero bound and get better return, all he had to do was raise the reverse repo rate 5 basis points. And if that didn't work, he'd just gone another 5. He'd have kept going until he got what he wanted. He didn't need to do anything else. I kept saying, well, if Powell really wants to screw Lagarde, all he has to do is go to 10 basis points. He never had to. He just kept doing that. Eventually, the inflation story caught up with him at the end of 2021. The Build Back Better died. All of this stuff died. And then he was finally reconfirmed as Fed chair when the FOMC elected him chairman pro tem until his reappointment, which for them forced Biden's hand to put him back in office. But Biden did not want to put him back in office. They were going to put Lael Brainerd in and go full MMT retard. So that $2.5 trillion, think about how much money they pulled out of the offshore dollar markets while raising rates at the same time. And they raised rates very aggressively at the same time, which then forced Eurobond rates out of the negative, forced the ECB to finally start going to raising rates. And Lagarde absolutely didn't want to do this. She's been dragged kicking and screaming, even the 2% for Christ's sake. Here we are. And every day that and we can continue to do this. And now that the markets have finally realized that the Fed is serious about doing away with the Greenspan put, the Fed put, but really the Greenspan put, once that is beginning to get cycle through the markets. That's why the Eurodollar markets are crashing the way they are. That's why we're finally starting to see the 10-year moved back towards 4%. And the markets are starting to finally realize that, oh, we're completely mispriced relative to what we expect the Fed to do.
So
and because of that, now the markets are doing Powell's work for him, and he can just raise by 25 basis points, and he's good to go.
Okay, so
but he may still go 50.
Let me ask a simple question about Healy. Everything that you just said about the euro dollar. So in term structure for the U.S. bond market, meaning 2s and 10s, we'll just say,
right,
fronts over backs. The Fed wants the curve to uninvert by the backs going up.
Yeah, eventually, yes.
You're saying?
Yeah, I'm saying that the Fed wants that to happen eventually, but they are okay. And again, Danielle used the phrase when I said everybody's screaming that the Fed made a policy mistake. She said they made a policy mistake on purpose. They wanted to push this idea. They needed to dispel the illusion that the Fed was going to be there for them, and this was just going to take time. And the markets have been conditioned. Bond traders for 50 years have, I've also said this many times. Right. Think back to when I was a teenager, when I was a kid, and we were going to the top of the gold bull market, and Volcker took us to 13, the prime rate of 21%. Yeah. At that moment in time, guys who were 22 entering the bond pits.
Yeah.
From then on, all they ever had to do was trade a primary bull market in U.S. debt. They've never traded a bear market in U.S. debt. They don't know how. They've never seen it until today, and they still don't believe it yet. So, but many of them are finally getting there.
So extrapolating that out to a whole continent, Europe is used to a bull market in bonds, and they don't realize it, but they're no longer on the same side of the fence with us for our own interests. Yeah. So it's kind of like a financial Monroe doctrine.
This is all out financial warfare. This is breaking. I think this is actually going back, and the New York boys saying we've had enough. The old money in the Vatican, the City of London, Frankfurt, all of that old money, the old Dutch money, all that stuff. We're in charge, not you. That's what SOFR is. Because the Fed's got collateral and liquidity sitting on its balance sheet, and it can do whatever it wants to recapitalize the money markets here in the United States. And we have our own debt indexing rate, which is a collateralized rate.
Right.
That's domestically circulates and the liquidity in the SOFR market is rising like exponentially. Right. Again, to your point about liquidities, money goes to where it's treated effectively. Money goes to where it's treated best. Right. And it's leaving the LIBOR markets. And the European markets are now dead. So what I see is a multipolar world. I see the United States surviving if the Fed is allowed to do what it's going to do, and China and Russia and the global South effectively being able to decouple, the dollar losing the global reserve status, but it's a multipolar world. And even Powell said in a Humphrey Hawkins testimony, there's room in the world for more than one reserve currency. He said this in front of the Senate.
Right. That makes sense in terms of complexity and deglobalization, but there won't be collapse. It'll just be retrenchments. So I have a question about the whole Europe thing.
Yeah.
Do you think, it doesn't really matter. We know how it ends based on what you're saying. Do you think we're triaging Europe, or there's animosity towards Europe?
I think there's actual animosity at this point. I think it's very clear that when you go through the entire process, that's why they had to install Joe Biden as president. That's why they had to effectively steal the 2020 and 2022 election. That's their modus operandi, which is to put their quislings in charge and to go to work against entrenched sovereigntist powers here in the United States. It's absolutely a junta. Absolutely.
Junta. I'm sorry, I can't even say it right.
Yeah, it actually is junta, but that's fine. There's no worries.
You mentioned about the whole, and I want to throw something out there because you may not have heard before, but I know that you're thinking it, and your audience may be interested in it. But you can edit it out if it's completely relevant to your comment about liquidity being created backed by gold. To your older listeners, after World War II, we were on a gold standard.
Yes.
And dollar, that means gold was a store of value, and dollar was the medium, and use the word settlement medium. And that's a Zoltan phrase too, was the medium of exchange. So we had gold, you use the dollars for your currency at like coins, right? And the gold is a store of value, right? Eventually we said, screw it, we're not going to let you have the gold. And the dollar then became the medium of exchange and the store of value guaranteed by our arm, our economy, whatever, our ways. Okay, the reason I bring that up is because you were describing, and by the way, China doesn't innovate, and I don't say that with animosity. China replicates and they improve, as opposed to Japan where they have to innovate to survive. Okay, so when you say all these different currencies, Iran, Iraq, Saudi Arabia, South Africa, all these different currencies are backed by the store of value, gold. That's the same idea. We got the world used to using the dollar as the medium of exchange. And we disconnected from gold. What they're doing is they're getting the world used to using gold as a store of value again and clapping on any currency as the medium of exchange. So they're making, because of blockchain, gold the medium of exchange, the settlement medium again, which is, the death of fiat.
It's really interesting. I've been saying for a long, long time. I mean, I'm just going back before I ever became a public figure or started writing for Newsmax or anything else. That was when I knew I graduated from my Austrian PhD. I went, the problem with the dollar is that it wanted to be all three facets of money at the same time. Unit of account, store of value, medium of exchange. That leads to Driffin's paradox. That leads to a hollowing out of the economy. That leads to all of these freaking problems that we currently have. And eventually they have to eventually that has to be decoupled again. You can't have all three of those things in any one currency. Or any one money. It doesn't work unless you can figure out a way to create the trust necessary to allow for that to happen through the digitization. But which in this case they may be able to do with gold. I think that ultimately, and I'm not even. By the way, I'm not taking Bitcoin out of the situation. This conversation, because gold is, and we're just talking about bearer assets. Ultimately,
gold, silver, Bitcoin.
Whatever. I think silver's got a different life cycle at this point.
It's industrial, but
it is absolutely industrial metal at this point. I wish it were otherwise, but it's just too useful in the real world. So therefore, it's like oil. It's too useful in the real world. It's got a stock to flow ratio of 0.
Right.
You know what I mean?
As a Bitcoin person, I'm going to say this: everyone who was like, "Oh, they're going to go," no, they're not going to go to Bitcoin. Forget the politics of it. They already have gold. They're going use what they all agree.
They already have. And they will, and the Fed has never said a bad word about Bitcoin. I'm not under Powell.
Right.
The Treasury has.
Right.
Davos has. The BIS has. Austin Carson just came out and said, fiat won the war against crypto. We're like, oh, really? Okay. That's nice. You're cute. Have another hamburger, you fat pig. It's just hilarious. I'm like, I don't know about you, but Bitcoin's sitting at 25 grand and there's no liquidity. And anybody, and anytime they try and bomb it, like everybody just goes back on chain. I'm like, okay, fuck you, go write a future. This is the interesting part about it. Have you noticed? This is what's really interesting. Since the dollar at the beginning of the month, since the dollar turned on a dime and started moving again, which is this moving higher again, which was a consequence of everybody waking up after the last FOMC meeting. And those 3 days after the FOMC meeting, that the FOMC, then you had the ECB coming in and basically saying, yeah, we're done. And we're going to, and now we're going to start doing corporate ESG based QE for corporate bonds. And then on Friday, there was the blowout jobs report, which no one believes, but believe 300 grand. And it's still a 4 sigma event, right? That's when the markets woke up and went, holy shit, the Fed's not going to pivot. Those 3 days were as significant as the 3 days after the June 16, 2021 reverse repo rate hike, because the euro dropped. That's when the euro bull market ended then. And it also ended here. Since then, the euro has dropped from $1.10. It's now trading at $1.55 this morning. As we're sitting here chatting, I've got it open in a window, and I'm actually watching it as we do this because I love watching the euro collapse. It just makes my day. It really does tickle my balls.
But hasn't it lasted far too long?
Yes, it has. But that's because of globalist forces within the United States government and the infrastructure propping it up through shoveling money at it, and shoveling euro, effectively shoveling credit at it. That's what I'm convinced that's what COVID was. COVID was just another excuse to force the Fed to monetize $7 trillion against Powell's wishes.
They know what they want to do and they wait for it to happen. When the light changes, they do it. That's basically it. Yeah.
That's how they did it. And then they convinced that moron Trump to go along with this shit because he was an idiot.
Right.
Because had Trump never signed the CARES Act, we would all of this would have already been over. we would be talking about a much different world today. And there would be détente between the Fed and the PBOC, and there wouldn't be a war in Ukraine. The war in Ukraine would have collapsed. Right. Because that they were able to firmly
right.
convince.
We kind of forced Russia into doing that. So,
yeah.
It's like,
well, we absolutely have.
Everything's a power grab now.
Yeah. So
maybe it always has been, and I'm just realizing it.
Yeah, no, it really already always has been. Vince, one of the things that when I first went to work with Newsmax a decade ago, writing a gold newsletter.
Right.
I was hired off of Seeking Alpha, literally. Within 18 months, I realized that I needed to up my game, and that these were far too politicized markets for me to make any, market-based predictions of where things were going to go. Everything came down to politics, and I became obsessed with understanding the geopolitical game board and what that meant in terms of money, and then melding it with monetary theory and all that stuff. That's where I went, and it took me 5 years or 8 years to get this shit under my belt to this level, if not longer.
No, I appreciate your ability to go from, you start with, not you, but we all start with understanding the fundamentals or the math, and then you go up to and I do this as well, but there's something I don't do. Then you go up to the 1,000-foot level, and you start to understand who benefits, the geopolitics of it all, and that's where I stop, and I just look for massive movements in behavior.
Sure.
You're actually like Bud Fox chasing around the individual people, going, oh, look, he went there. Oh, he went there. And you're like, oh my God, it's right. It's like, if you just follow their jets, you know what's coming next.
Well, part of it is that it's a very wise man once said, personnel is policy.
Yeah.
And so after a while, when I first had that moment, and this whole thing with the Fed, honestly, I was like, I can't, no, this is not happening. I had this moment where I watched the 5 basis point move on the reverse repo rate, and then the euro collapsed, and I went, why?
Right.
And then all of these things that I had read, well, Martin Armstrong talking about this, and this guy talking about that, and this guy talking about that, and all of a sudden it all just kind of went, and I had that classic big, huge mimetic collapse, and I went, yeah, would the Fed actually be at war with the ECB? I went to my people that afternoon, and I said, could this be happening? And one of my patrons, who was very active at the time and who knows a lot of these people and is, just hedge fund manager and whatnot, he just said, look, they don't call him private equity Powell for nothing.
Right.
And I went, he's not cut from the same cloth as Bernanke and Yellen. And that means he could be working for, okay. And then from there, just like, okay, let's start watching it play out.
Right.
Am I right? Well, let's collect data and see,
He's a private industry guy. He's not a globalist.
No, he's not a globalist.
Right.
No. And then to hear Daniel Booth talk about this stuff, because, when Powell has always been the hawk, even when a junior member of the FOMC, he's always been this guy questioning this 2% inflation policy and this and that policy and that policy. He's always been that guy. So maybe. And then you got to ask yourself, how does he become the FOMC chair under Trump?
Right.
And then who's standing behind these people and putting these names? How does this happen?
Right. So Powell's I don't want to get off. So are you implying that, I know when Powell first came on, I was studying, I'm like, what, he seems kind of reasonable. And then after a while, I'm like, he's like everyone else. That was my conclusion, but I've come full circle on that, or at least.
I think that circumstances kept forcing his hand.
Right.
But if you think about remember also the timing was never right. When the SOFR crisis of September 2019 happened, that was because of JP Morgan refusing to repo as collateral any European sovereign debt trading at freaking negative. They weren't going to repo German debt, 2-year debt trading at -1%. They're like, fuck you.
Right.
And then they were the first bank, right? And then that started that crisis, and then they had to deal with that. And then the Fed, papered it over and did what they needed to do to shore up the banking system. But again, SOFR was still being rolled out. Remember, again, back to your original point, we didn't go from LIBOR one day to SOFR the next. SOFR started in 2017 as a pilot project.
Phased in.
Phased in over 5 years. And it was in January of 2022 when Powell was due to be reconfirmed that all new U.S. debt had to be indexed to SOFR and not to LIBOR. That was January 1st, 2022. And
so you think those two things are tied together?
Yeah.
I mean, not coincidentally.
No, it's not. I don't think it's coincidental at all. I don't.
Okay.
I think that's why they ran out the clock. They tried to run out the clock on Powell's reconfirmation and then install Lael Brainerd, who would have reversed all of that.
Right. She would have reversed that. Yeah. In fact, it kind of makes sense because people that are cheering at Lael Brainerd being pulled out, she's not being pulled out because of not adhering to what they want. They're going to find some other place where she can be the boss.
Well, I think she's getting the golden watch. I think that's where she's always been very politically motivated.
Right.
She just wants the big gold watch. Yeah, they'll probably move her into as Treasury Secretary for the last, just so she can have it on her resume. So then she can go and hit the speaking tour circuit and all, and get the consulting fees. She's done because Powell moved her out. I'm convinced of that. She saw that she had no power as vice chair of the Federal Reserve, but she had no power on the FOMC, which is where the real power in the Federal Reserve lies. Again, the podcast I did with Danielle, we went over Danielle DiMartino Booth. We went over all of these little things.
I'll give that a listen. Are you also saying that? All right, so not are you asking if the Fed and we'll just say the U.S. junta is at odds monetarily,
mm-hmm.
and these type of people don't back down,
yep.
then the Brainards and the people that are in control of that aspect of the economy, they're going to push back too.
Yeah. Why do you think we're pushing? Why do you think they're pushing for more war? Because then they have to force the Fed to monetize trillions of dollars in new war spending.
The neocons and MMTers are on the same side of the fence now. Great.
Yes. Isn't that great?
Basically it.
They always have been, but now it's just above board.
Right. They're all Trotskyists.
Yes, they are all Trotskyites. Very much so. Cool. And they'll never permanent revolution, they're all Trotskyites. It's all just bad. I'm not even going to go I'm not going to go any farther than that. Everybody else can and then there's the Brits. We don't even want to go. Like, nothing makes me happier than watching the Brits squirm because they're the architects of 90% of the shit. They're the ones who feed all this bad intelligence into the State Department and the CIA, and then it gets filtered up to the National Security Council. And these people, like I say this all the time. You know why the sun never set on the British Empire, right?
Why?
Because God didn't want these fucking people running around in the dark.
Okay, I get it. I didn't see them as that powerful still, but they are. I mean,
yeah, they are. They really are. Christopher Steele, everything about the Russiagate was all driven through MI6.
Right, and the UK. I remember reading when the Russians were discussing how they think it could play out. At the tip of the offensive against them, or I'm saying objections to what they were doing, they were convinced, and they still are, that the UK would be the instigator of an escalation between them and Poland, or between them and like a dirty bomb. So,
yep, absolutely. Like Putin very clearly used the phrase Anglo-Saxons after both the Nord Stream bombing and the Kerch Strait Bridge bombing. He did not use the phrase Americans. When he talks about financial diplomacy and financial warfare, he uses the phrase Americans, and so does Medvedev. But when he talks about the other stuff, he's almost always uses the phrase Anglo-Saxons. This is a very important distinction. He knows where this stuff comes from.
I could do this all day. No, this is stuff that I'm not thinking about. But yeah, okay.
Okay. Well, we'll just have to. What I'm going to say, Vince, is we'll just have to do it again real soon now, if you like.
Absolutely. So, I want to leave you with one thing, and this is a hat tip to you. Last month, with the whole Ghana oil for gold thing, I did a little Tom Luongo, and I looked up the dates that they were announced that they were going to do it, and the dates that the gold was delivered, and then I looked up what the president did for those weeks. And the president of Ghana traveled to, this is like to your thing, president of Ghana traveled to England for a private visit for 3 or 4 days when they announced it in November. And then he made another private 5-day trip to England in January when they delivered it. And I went, oh my God, really is butt fuck shit. and you know what's going on. And
It's
the
right in
UK
front
is
of you. You just know where to look. It really
right in
is,
front.
man. It
It's
really
pretty
is.
scary.
It is very scary. All right, man. This has been really, really cool, and I've really enjoyed every minute of it. But we've gone over a lot for people to chew on. So hopefully, this is one of those ones where people are like, I need to listen to this one again.
Yeah. Oh, I know I do anyway.
So,
it's really fun. I'm very happy to finally have gotten a chance to do this, and I look forward to doing it again. And I'll see you around the social media world.
absolutely, man. You take care. You have a great weekend. We'll talk soon.
Thank you. You too.
That'll about wrap it up for episode 135 of the Gold, Goats, and Guns podcast. I want to thank Vince for his time and expertise and his willingness to really go into the deeper corners of this thing. I don't know about you guys, but I had a blast with that conversation, and we'll try and find another one and do the thing with someone else real soon now. So as always, you can follow my work over at my blog at tomluongo.me. You can follow me on Twitter at TFL1728, and you can sign up for the Patreon at patreon.com/Gold, Goats, and Guns. There's links on the blog. There's links. I put stuff on Twitter all the time about it, where you can sign up for the twice weekly market reports and or the monthly Gold, Goats, and Guns investment newsletter, where we go over all of this stuff and try and make a portfolio strategy out of the noise and the crazy. So that sounds good to you. Check it out. You guys be well. You take care. We'll talk soon. Keep your stick on, guys.